if you raise primary, you have to actually expense it out. Unlike in the private market, you cannot just keep it over there. And
like in my parents' generation, people said that they bought a Reliance stock and that helped them marry their children or send their kids to school. So eventually, one day, 20 years down the road, if I meet shareholders like that, that will be a dream come true, and that would be the true purpose of going public at this stage.
It's not recommended that you put a pool without actually talking about identifying the target and then doing that. So they don't typically like a blind pool that you can do anything with it without specifying the target.
Hi everyone, welcome to 100x Entrepreneur Podcast. This is a very, very special episode. I have the building behind me. It's called National Stock Exchange. It's every entrepreneur's dream to become a public company and list on National Stock Exchange or Bombay Stock Exchange. Today, I have with me entrepreneurs who have fulfilled this dream for their team, their investor, and themselves. So welcome Abhishek and Neha, founders of Tracxn, on the podcast. Tracxn is one of the world's top 5 market intelligence platform on private companies. Tracxn is used by more than 800 customers in more than 50 countries. And as today, Tracxn has more than 67 crores in annual revenue, currently valued in the public market around 800 to 900 crores, profitable also in this quarter. And as we speak today, they are listed on the National Stock Exchange and Bombay Stock Exchange. So Abhishek and Neha, how is this feeling of going IPO?
Thanks, Siddharth, firstly for having us. It's very exciting. I think when we started the company probably 9 years back, this was one of the goals that you actually become a listed company in some journey, some years to come. But we had not imagined that all this culminated in the last, I would say, 1.5 years. And we started working about end of 2020 when we started the process of thinking that let's start the listing process, and then we finally submitted our DRHP in August last year and then got the approval end of last year. So I think it's been a fairly exciting journey, and we are really excited about continuing this journey as a listed company for the decades to come now.
Abhishek, how are you feeling right now? Any churns in your stomach as you go public? And now the fate of the company, you have given little bit in public's hand.
No, it's a very surreal feeling. It's something we really wished, and this is what we imagined when we started the company. I'm really happy that we are finally here, and it's a very big moment for me.
And take us through the journey of how you prepared. Like, first of all, internally yourself, what was the discussion between the founders, and then how you talk to the team and investors that, taking public is the right path to go. And then what are the preparations needed to do it?
Funnily, we had actually thought about that listing is a good option when we were starting the company. And that is one of the reasons why we also had the HQ of the company in India, though we are a global platform. So 70% of our revenue is still international. But we did realize that, our base will always be India. Like, our team currently is entirely based out of India, and then we will probably hit the listed market at some point in time in the journey of the company. Probably when we started, we actually took that decision of having the HQ in India and building the whole team and everything from here, like Make in India, though it's a global customer base. And end of 2020 is when we actually started to work on the listing process seriously, because the markets looked sort of very conducive. So December 2020 is when we actually thought about internally, we decided let's start the process. And by the time you finalize, you start working, like in listing process, you have to work with some set of intermediaries, especially a banker, then the legal counsels, etc. So that we finalized by March of 2021. And then it took us about 3 to 4 months to do the DRHP filing. You have to do the DRHP filing. You have to move to, NDS accounting format, etc. So there are some of the things which are required on that front. So August is when we filed the DRHP with SEBI, and it took us 3 months to get the approval. So, a little in the second half of November is when we actually got the approval. That approval is valid for a year. So essentially, based on the market conditions, you can hit the market any point in time in the next 12 months from the approval date. I think the markets basically, beginning of 2022, obviously given the rate hike, etc., they were a little bit in the red. And in the middle, when we saw good opportunity, we started to sort of prepare back to hit the market. So we updated with the June financials and then, hit the market now. And, voila. So I think everything sort of culminated to finally closing the whole issue and then, us hitting the markets soon.
One of the other things that people need to do is you have to be mindful about going public from very early on. So you have to make sure that you are not cutting any corners on any compliances, because otherwise before the listing process, you'll end up spending a lot more time. So in our case, our CFO was among the first 10 employees to join. We had Big Four from last 7 years. So all of of these made sure that we were mindful of doing everything right from very early on, because retrospectively it takes a lot longer to prepare if you are not being mindful from very early on. So because of that context, I think it took us a lot lesser to prepare for the actual listing process eventually.
And how did you split the role among yourselves, like between each other and between the key team members, that ye karega to be prepared for the IPO?
So I think we did a very interesting thing. I think the finance IR team was probably working throughout for the whole process. The other company was as is. So thankfully we didn't have to change operations because we had anyways, built it very cognizantly, from day one. We didn't have to change that. So that team actually, sort of continued to work. And then the IR and the finance team, obviously we sort of augmented that, because then there is a very intense process. You have to do all the things.
If you can recall, like how many documents you had to submit to SEBI, let's say, or any other regulator for getting the DRHP filing?
So that is a very interesting process. So the filing that you have to do with SEBI is just one document which is there, but there's a lot of things which go behind it. Thankfully, we have been working with like a big four PwC as a auditor for the last 7 years. So there was this continuity which was there, and then you have to change accounting format. So that was a minor thing that we sort of, changed. Second thing is that, for instance, for a lot of our shareholders, we were probably the first company in their portfolio to be getting listed. So a lot of them, for instance, your shares required to be in DMAT format. Some of the investors also had to open DMAT accounts because, we were the first company in the portfolio to be hitting the listed space. So that was interesting. So a lot of other things that goes behind, the scenes, like you have to augment your board. We got in really experienced people on our board in addition to the investor nominee, which had already been on our board for the last 5 years. We also sort of augmented that. So all these things, probably takes us like a few months to then before you do the filing.
Abhishek, you are, starting a new trend for startups, that going IPO at 10 million ARR, whereas the market expects you to go IPO at 100, 200 million ARR. And thereby, you are also giving the public an option to create wealth along with you as you grow to 20 million ARR, 30 million ARR, and thereby the valuation of the company also increases for the retail investors. Does it go against the private investors norm, the VCs, that, they are expecting $1 billion outcome from every of their companies?
So first is, I think if you look at Indian market, a lot of IPOs has been around 500 crore to 1,000 crore float, which is a fraction of your company. It will be anywhere between 25 to 40% of your company. So that is a sweet spot for an early IPO in India. And as you grow larger, I think if your float is more than, let's say, $1 billion, it gets very hard for Indian market to absorb it in today's context. So if you look at public market, it's a much older ecosystem in India, and venture ecosystem is relatively new. And I think a sweet spot of entry in the market is between $2 to $500 million valuation. That is a sweet spot where Indian market can attract a company. So that is how entrepreneurs can potentially plan for it. And these two ecosystems are slightly different. And eventually we will learn as a country what is the sweet spot at which a company should transition from private to public. And in our case, there was always an aspiration to go public, and when we thought there is a right opportunity and we got interest, so we started working towards that. But I think, in my opinion, we are still in early days of learning when startups or private ecosystem, when should they transition. And I think, and over time as we go forward, we'll find more sweet spot as to what is the right way to enter. But what I'm really excited about is we are entering at a stage where there's a lot of growth left for next 2 to 3 decades. One of my aspiration is that, like in my parents' generation, people said that they bought a Reliance stock and that helped them marry their children or send their kids to school. So eventually, one day, 20 years down the road, if I meet shareholders like that, that will be a dream come true, and that would be the true purpose of going public at this stage in India.
Yeah, that will be like the Dhirubhai Ambani moment for you guys. And was there difficulty convincing your VCs that, hey, we want to go IPO right now and not once we hit like more milestones in our revenue journey or customer journeys?
So in terms of the investors, I think we've worked with the investors from early on, and we raised our first fundraise 9 years back, first institutional 7 years back. So there was already a lot of history that was there. So I think that was the easier part. On the other part, when you say, when is a good time to actually hit the markets, another thing, in addition to the revenue, another thing which I realized that the Indian public markets also really likes is the profitability. So they want you to, hit the market when you have a clear path to profitability or you've already become profitable. And that is also one of the reasons why when we actually started the process is when we had actually turned cash flow positive. So we started the preparation of there because, at that time it was sort of fairly clear to us from all the people that we had spoken to is that Indian public market sort of, likes profitable stories, like companies with good bottom line. And in our case, we had actually turn cash flow positive much earlier than bottom line positive because, we do cash collection upfront, we have a prepaid billing, etc. So even last year, if you were to see, that was sort of cash flow positive. So I think in our thing, what I realized is a good time to sort of, hit, and what also the investors sort of understand well is basically, when you have a good part to become sort of having good PAT, when you have good visibility on that, that is a good time to also, start preparing for the listing process, especially in the Indian markets, because that is what a lot of investors have typically, used to seeing and liked in companies.
Hi everyone. Before we begin, I would like to share that this podcast is brought to you by Prime Venture Partners, an early stage VC fund led by Amit Somani, Shripati Acharya and Sanjay Swami. Prime is often the first institutional investor in category defining tech startups in fintech, SaaS, healthcare and education such as MyGate, Quizzes, Planet Spark, Bolt and Clip. To know more about Prime, visit primevp.in.
Just to add, I think in our case, two things really worked well, which sort of, resonated well with investors. I think one was basically the non-linear EBITDA expansion. So in our case, because of the fact that you have to initially do a lot of upfront investment in building the whole data platform, etc. And then you can, keep reaping the benefits of that once you build the data for different countries. So that was one interesting aspect in our business that, the EBITDA has been expanding in a very non-linear fashion if you look at it in the last 3 years. And the other thing that people also like is basically your increasing free cash flow. So you have your business is generating free cash flow and it has shown an increasing trajectory. So I would say that is also sort of good things to sort of keep in mind when you're thinking what is a good time to hit the public market.
And I would like to ask you, right, who are the mentors or people you took advice from to go IPO, right? Once you start, I remembering, once Abhishek and I had a discussion connecting with Nitish Mitra Sen from Nazara, and who are the other people that helped you, and what are the help required externally? They say it can be validation, it can be processes to get the path right.
If you look at our private market journey, we were fortunate to have had sort of backing from some of the investors who had seen the public markets. So for instance, in US, we had an angel investor who had been on the board of a lot of companies who had listed in US. So obviously US is a much deeper market. A lot of companies have, seen that journey. So that was a very good learning experience. Here, obviously, we are fortunate to have had the backing of Mr. Nandani Lekhani, who have also seen the whole sort of journey. So I think advice from those people were very handy, seeing it firsthand of what, they have seen the private to public journey and seen that years in public life and how, as a company, what maturity you need to reach to be able to sort of run the good publicly listed company. So that was very helpful. In addition to that, we obviously took advice from a lot of people who have seen in the venture ecosystem. Actually, there are only a limited set of companies like venture-backed companies who have IPO'd. So we also obviously took advice from, a lot of people who have seen this journey in India. Good part is that that's an increasing set. So, probably earlier there were less than 4 or 5 people who could probably speak to get this experience firsthand. And the good part is that, that's probably increasing.
And any set of, people who said, right, that, hey, this is not the right time to IPO because you started preparation in the COVID market, right? When there were 2 years of complete uncertainty. And as you went and prepared in 2022 to go public this year, the global markets melted down. And today in US, good SaaS companies at 200 million annual revenues are trading at 2x, 400 million of valuation. So did it deter you? Were there any fears in this process that they might be, the 2022 market is not right?
So I think in terms of the market timing, you can perhaps time it to some extent, but not to a lot of extent, because this process itself is, at least even if you do it very smoothly, it still takes about, 6 months from the time you start the process to you hitting the market. So you can perhaps take a bet, your business is ready and the direction wise you are getting sort of good traction, when you're speaking to investors, you're getting a good traction initially. Initially you spend a lot of time in meeting the institutional investors, obviously, and you get sort of a good feedback from there. So I think once these two things are there, that, your business is ready and then you are also getting good feedback from investors, that is probably the time that you can plan for. Otherwise, where the markets will be at the end, it's a little difficult to time because, it's anyone's guess, how the market will be probably 6 months from now. So the process itself is, at least takes 2 quarters. years or so.
And did you think that, if COVID wouldn't have happened or the markets wouldn't have melted, you would have gone IPO sooner?
Looking back, I think we were able to do it at a fairly good pace. So it was glad that, everything sort of worked out, like the market environment, etc. also worked out. I think right now, obviously, like if you compare it to last year, markets are fairly, lower in that sense. That's there. But I think there is still sort of demand for, I would say, good companies or, good assets, which is still there. So I think looking back, I think we are fairly glad at the pace at which we were able to sort of execute from the time that we, first started thinking.
Abhishek, you raised 135 crores from pre-IPO round.
Correct.
Was it tough? Was it easy? How was it?
I think this was as a part of entire IPO, you have to close an anchor allocation before the opening the issue. So it was part of that itself. And this is the main book that you have to close before you actually launch the public issue. And so when you start the process, I think once you file DRHP, you start meeting investors and part of their money will come under anchor book. And we were fortunate to get like very good, interesting mutual funds like usual who's who, like Kotak MF came, ICICI came, Nippon came. And on the other side, White Oak funds like White Oak came, Abacus came. And this was the period where you also, bankers work with investors to do price discovery, and you typically want long-term investors who understand your model really well and also works with the banker to set up a good price. And I think this was a long process. I think I'm happy that we ended up spending a lot of time with them. It gives you an opportunity to actually explain them long-term vision of the company. So I think this is the most rigorous part of the IPO. You end up meeting more than 50 investors and eventually hope that between 5 to 7 good investors come and work with you. And if looking back, if you were to ask me before starting the roadshow, who are your top tier names, some of them would clearly be in that list, and we were very happy that we got some of the blue chip names in that ecosystem to come and work with us.
So let me ask you both, which was the most stressful part of the entire IPO process?
I think the most stressful part was the market uncertainty. So I started probably following macro more than I would have ever done in my life, like because the business is not so much impacted, with the macro. So you keep running the business as is, looking at sort of the customer segments that you work with. But in this market, I think the macro sort of impacts so much because it's the overall, the investor have exposure to this whole, different assets in this class. So I think that was probably one of the key things of just, following when was the rate hike going to be there, and, what was that going to be there, which I've never followed earlier, while running the business, but now we had to follow that.
And you feel so helpless because on the business you can work on and do something. On the macro front, there's only so much you can do. And while we were about to open the issue in the last few weeks, there was a lot of conversation on war getting escalated. Then we were really on our toes, like constantly checking that something hasn't escalated, and our anchor book was closed. And then because of this whole war conversation, the market started to fall. So that was, I think, the most nervous period, that everything is done now. And I sincerely hope it's a big human catastrophe, but we were so nervous about it because of that. So the last 2 weeks have been the most nervous part of the entire process, I think.
How many sleepless nights you would have in the last 2 years?
That
because
I think is forever. I think we started thinking about it in December 2020.
Yeah.
So I think typically when we started the process, a lot of people advise us that, look, it's a 3-year process. Go enter with that mindset. If you lose the steam in between, there's no point of working on it. And a lot of people said that first 12 to 18 months will just be internal readiness. So in our case, when we started working, we realized that within 2 to 3 months, that internal readiness is very high. So when we started working with the bankers, they did the initial DD. I think everything looked like in place. So then we got really accelerated, but because of macro, it became slower in between. But I think that was one of the big things that we sort of went through.
Right. And I would say, I think there's the other sleepless nights is also because, earlier you had investors, which are probably, people that you have worked with or people that you've known previously. Right now, there are a lot more investors who are, sort of people like retail investors, so there's a lot more responsibility, I would say, in that. Probably that is one thing that, gives us sort of high sense of responsibility that you have to have across not just yourself, but, across in the company.
So Abhishek and Neha, can you share the feelings that you went through? What are the roller coaster ride of emotions? Was it fear, joy? What were these? And you guys will also become like very young parents. Your kid is 1 year old. So it's like first kid is graduating and now you have your second kid.
It's a great journey to have gone through the whole thing. One is, you keep thinking as an aspiration that you as a company, I would say, see, if you as a company, if you want to continue to build it for decades, if you feel that the market is very deep, then obviously getting listed is one of the top options that you have if you're building a company. And, to finally, from the thought of getting listed to, having closed the whole loop, obviously, that's a very exciting journey, I would say. And I realized that there are so many stakeholders that, work in this whole process, being from bankers to legal counsels to both India, international, etc. Such a, huge amount of work that goes behind the scenes to making that possible. And, to finally, move to the other line, I think that is the very exciting thing. Everyone's sort of effort sort of paying off, culminating into the offer being closing and, you getting listed. So I think that was the whole, thing which was interesting in the last 1 year, that so many things had to sort of work, in tandem for you to, sort of getting listed.
It's a lot of work. So I think for 18 months, we were constantly running very hard. And there are always going to be moments when you feel that nothing is happening. I don't know if we'll come out or not come out, and you keep hitting roadblocks. But I think there is a lot of progress being done. I think there are at least 3 to 4 moments when we thought that we are completely stuck and we're going to miss this cycle and we'll have to refile again. But thankfully, in the last few months, market condition improved and we were able to come out. But it's a lot of work with a lot of emotional highs and lows. And there will at least be 3 to 4 moments when you almost feel that we are stuck at some place and nothing is happening right now. And these can be a lot of times it were technical issues. So sometimes it was net worth thing. So all investors get a clause of buyback. And technically, from an auditor's perspective, if you have a buyback clause, the company's net worth is like a lot of negative crores, because whatever is the net worth, company is supposed to buy back, right? So whatever value generated directly goes into a negative net worth. And at March 31st of that year, or the previous year which you are filing, that clause has to be removed. And we discovered that clause on like last week of March. Thankfully, we discovered if we had gotten into April, then we would have lost one entire year. So these were very, very small technical issues that you run into when you're doing it for the first time. And then thankfully, like every time something worked out and you are able to cross that and not lose time. So every time you run into such a roadblock, you basically lose a quarter or a year typically. So, and when you discover it for the first time, and if you don't come across in the next 3-4 days, and if you don't solve it, then you lose the entire cycle. So emotionally, it is a very turbulent experience. But I think eventually it's all about outcomes. So if you finally get the outcome, everything is sort of worth it. But if you keep losing time, then you obviously, it's a much more draining exercise.
I think our team had a good time. Like they had probably, had a lot more night outs, I would say, in this whole process. Like to just give an example, when we had filed the DRHP, it was probably, I think like 4 a.m. or 5 a.m. time. So that means that our entire team, all the legal counsels, bankers, everyone was up the whole night in doing those small sort of iterations, so that everything is into place for us to be able to do the filing. And similarly for a lot of other filings, that was also done. So, typically the target is, before like 12 a.m. But it typically sort of goes because, you need a lot more other dependencies that are there. For instance, simple thing, right? Like, you work with an auditor also has to coordinate with their US counterpart, US team. So they have to get, some documents from there. So there are so many moving parts that a lot of time of filing would happen like, early morning. That means everyone would have worked, across the night. So that time, I think our team probably had, a lot more, I would say, night outs in this whole process.
Was it any moment that you like gave up? Yaar, ab nahi ho payega?
Oh, yes, absolutely. This is net worth or that thing. I think I remember 29th March or something, it was a weekend, and then we were walking and saying, this is stuck. How do you resolve that? And then suddenly we realized that, we can actually request investors to waive off some of these clauses. And touchwood, like in one day, everybody turned around and without pushing us back that why are you asking us to give us some of these exit rights, which are very critical to investors. And so many times some of these things happen. Sometimes in regulatory approvals, you are stuck and nothing is moving. And you almost feel that this cycle is because everything is on a tight timeline. Our approvals were getting expiring on November 12th. So if for whatever market condition, even if you lose another 2 weeks now, you have to just redo the entire thing, which is a very long, draining 6 to 9 months.
We are just like 3 weeks away from November 12th.
Yes, absolutely. So it's
yes, it's always a hit and a miss. I would say.
I think before even 1 week before the anchor book was filed, we actually had a discussion key. Maybe we are missing the cycle. I think we were going to office and we were like, there was a constant phone calls going on between different stakeholders, and it was almost, we were like practically mentally accepted that this cycle won't happen now. So that moment kept happening, I think, but there's light at the end of the tunnel. Somehow things always worked out. We were always able to find one solution to it and then kept moving forward. But I think a lot of it was also, we had that expectation. A lot of people had told us that you will hit these roadblocks. It will be a long tiring process. Don't enter it until you are really sure you want to go through it, because your conviction will get tested again and again and again. And in some case, we were mentally seasoned to expect many more challenges than these. We had practically budgeted 3 years for the cycle to get over. We had practically accepted a lot more hardship. So because of that expectation reset, I think it felt as if it was like lesser than what we were mentally prepared for. That turned out to be okay.
But how do you mentally prepare for this kind? Because whatever mental preparation you do, nothing comes when you hit the road.
Right.
No, I think it was always that we knew that this is going to be tough and this is going to be turbulent. So I think you signed up for it, so you can't complain.
Dear listeners, before we dive further into the podcast, I would like to welcome Prashant Ganti, Head of Product Management at Zoho Payroll and Zoho Books. Prashant, what makes Zoho Payroll different from its competitors?
Thanks, Siddharth. So first off, right, Zoho Payroll from the ground up has been designed so that it can address the payroll complexities, startups, as well as larger enterprises. So once you have signed up, started using Zoho Payroll, you're never going to outgrow it. Secondly, it's very easy for you to onboard your employees. Your payroll department can easily get the hang of Zoho Payroll very easy. There's no complexity. We have abstracted all the complexity. We take all everything is handled under the hood. Thirdly, Zoho Payroll plays very nicely with the Zoho ecosystem. So once you have signed up and started using Zoho Payroll, and once you have expanded your Zoho footprint, you see the benefits of integration and data movement, thereby improving decision-making across your organization. And finally, Zoho Payroll is not just a product, it's going to be a platform as well.
Thank you, Prashant. Dear listeners, you will find more about Zoho Payroll in the show notes. Now, let's further continue with the podcast. Like you mentioned about the buyback thing, right? How many items were there in this IPO checklist that you had to fulfill?
It was not like a well-defined checklist. We kept going through it and kept discovering, because a lot of these sort of ecosystem players, they've also not seen like venture-backed companies going public. So they are also discovering nuances of a lot of foreign investors, a lot of people who have different counsels. So these setups are also new for them. So we are, as an ecosystem, we are learning how to take some of these companies public. So I think these are nuanced points which sort of they have not seen in a lot of cases earlier. So that is, I think, part of the learning curve. And even for regulators, these are new set of companies where promoter holding is not 100%. So a lot of people are used to seeing promoter holding 100% of the company. Actually, there are fewer companies where promoter don't hold 100%.
A venture-backed company can never be 100%. Most of the cases, till you reach IPO, you are like 30, 40%. You get a 50%.
A lot of people even asked us that how come you only have 50%. So I think this is a new thing. There are a lot of so people are discovering how to sort of deal with some of them. And it's not as if a well-defined checklist. You keep discovering things on the go. And then sometimes those things are difficult to solve. And that can sort of hamper your time as well as your, I think, enthusiasm.
And you structured this IPO mostly as offer for secondary sale.
Absolutely.
Yeah.
You didn't take any money for growth of the company.
Correct.
No, that's a very interesting point. Actually, not a lot of people, actually know this fact, but if you raise primary in the IPO, then you have to use it in the next 1 to 2 years, and that is basically monitored also. So, you have to give the use of proceeds initially, you have to use it for those. And you cannot, unlike financing in the private market, you cannot just keep it for unallocated items initially and then use it, at some point in time. You have to actually expense it in the next 1 to 2 years. And in our case, because we were cash flow positive and we were bottom line positive, though we have been fairly aggressive in the growth of the business, all our expansion has actually been, we are able to sort of finance it from the cash that the company generates. And we still haven't used the last, fundraise that we had done in the private markets also. That's still cash in bank, which is there. So that is an interesting nuance, which not a lot of people know, that, if you raise primary, you have to actually expense it out. Unlike in the private market, you cannot just keep it over there. And the second thing is that, if you're a profitable company and you don't have a lot of capex requirement, because you don't have to set up large factories, you don't have to, it's a fairly asset light model, I would say. So there isn't a lot of avenues that you can actually deploy it. Like if you want to buy like an office building or something like that, that's not something that investors really like, you sort of lock in your capital over there. But that was an interesting nuance that we actually realized when we started working on the process, because that was very different from how, you do a fundraise in private market versus, you have to do it in the IPO market.
So we started with like saying 100% primary will do. And then, so we said that we deploy. So one of the ideas was that we can buy an office space. So even for that, I think you have to finalize the details. You have to produce all the documents as a part of DRHP. And then you have to buy. You can't just say, okay, I will buy 30 crore or 50 crore of office building and I'll find the building later. That's not how it works. So we realized that that system was very watertight and we can't put like additional 100 crore into the business because business has been self-fulfilling and these are expansion. Like EBITDA has been expanding, free cash flow has been increasing. In that business, you can't commit to put another 100 crore and do that. So I think then 100% OFS becomes the main option. And then also it sort of is also a testimony that company is generating cash. I think one of the biggest questions that we got during the process was profitability of tech companies and startups in general. So people were, when they saw 100% OFS, that was also testimony that company doesn't need a lot of cash, or you will not do the IPO and then go and raise 200 million to fuel the growth. So that also built some comfort that whatever we are saying that it's an expanding EBITDA story, increasing free cash flow story, sort of that added to a proof for that rather than just a negative thing. And our team headcount has increased a lot. They saw that in last 1 year, investors saw that our team grew by 150 people.
So what is the team strength right now?
So today we are 800 people, and they saw that despite adding 150 people on a base of 650, we were continuing to show EBITDA expansion and free cash flow increase. So that way, OFS was a supportive of our profitability story, and that was one of the reasons people really like the story.
The other thing, what we realize is regulators also don't like is that, even if, for instance, in our plan, we've given that inorganic is, something that we'll probably do in future, because in general, financial data companies, you see, are fairly aggressive on inorganic expansion. It's not recommended that you put a pool without actually talking about, identifying the target and then doing that. So they don't typically like a blind pool that, you can do anything with it without specifying the target. Ideally, if you have sort of boiled down to a particular target, you give that and then, you give the details in the filing and then you can sort of raise money. So that is one of the things that people also don't, we realize that people also don't like, that they don't like a pool of capital which you can, use it in variety of manners. They ideally would like that, if you're going to use it in some manner, you have to give the use of receipts, and that is why I think the OFS sort of worked well because of the fact that, the businesses, as Abhishek was mentioning.
And our advisors also said that preferred route is that at some stage after 1 or 2 years, if you do want to do inorganic, then it's very easy to do QIB. That time you identify target, you produce all the diligence documents, and then within a week or two, advisors will be able to get all the required capital for that. So I think because of this whole dynamic of primary and secondary, I think it made sense for us to do 100% OFS and sort of build a comfort that it's a cash generating company, and that is what is the need of the hour for investors also today.
So Abhishek, now you have become a Midas touch for companies going public. You were the first investor in Delivery which went public. Now your own company is going public. I see entrepreneurs lining up at your door. You just put a token money in my company so it may go public.
No, I think there has been a lot of people have reached out to us over time that what does it take? Because this is not something a lot of people told us. When we were starting, it was not the playbook is not obvious that what does it take for some of these tech companies who require a lot of initial upfront investment to actually go public. And we had the fortune of having 1 or 2 shareholders in US who had seen this story play out in their markets, and they shared what they thought was the right thing. And I clearly remember in the first few months, like there was a conversation with me that saying that at some stage you have to decide, are you building it for M&A or are you building it for IPO? Because if you're building it for IPO, you have to make sure that after 1 or 2 rounds, you didn't raise at the peak of boom cycle at a price that your IPO is pushed by 5 years. So if you end up raising in 2021 at a very high price, and public market anyways give lower valuation than private market, and at the peak of private market, if you raise at the premium valuation, you can't do IPO for 5 years then.
You had an option to raise in the 2021 market.
Like last year was very crazy. Most people could have gone out. We didn't go out because we knew we wanted to do IPO issue, but you could have gone out and gotten a very high valuation in the last year. But then you push it out for 5 years, and by then another boom cycle will come. So a lot of people fall into trap of raising at the peak of the cycle and getting valuation to a point where public markets can never accept that. So I think in our journey also, after first 1 or 2 rounds, we always made sure that we are not raising too much. We are building methodically. In a lot of our conversations, at least once or twice a week, we would always say internally that build as if you are building a public company. Don't do something which you think is not open for scrutiny or not open to debate on merit grounds, right? Because eventually we'll go public, and at that stage, if you have to redo this vibe, do something like which has to be replaced later. So I think that mindset really helped. I'm hoping that we will help discover part of the playbook that people can potentially follow in future to go public.
Yeah, I think the other thing, I think Indian markets have also matured a lot. Like if you look at the number of interesting stat is that if you look at the tech companies market cap to the total market cap of Indian listed entities, it's only about 1.7%. That is 34% in US, for instance. So earlier people used to say that, if you look at Indian equity space, there are hardly any tech companies. If you look at get, compared to a market like a US or a China. But I think that is increasing in a good direction. So people have started to understand the tech models. People have started to understand these kind of companies. And now that is expected that, in the next 5 years, that will increase from like a 1.7% to, like 15%. So that is expected to sort of increase. So that is also a good directional thing from the markets that, earlier people used to say that, these markets have not seen a lot of companies. So there aren't a lot of peers. There aren't a lot of other companies to look at, to understand. But that is changing right now.
So let's see. I really hope that a lot of companies now in future take this path of building more meticulously and building for long run. If you're going to go public, everything has to be ready. So it's not about just hitting targets and milestones. It's also about how you achieve these or what processes do you set up. So it's a mindset shift, and I'm hoping that a part of Playbook will get inspired by us, and I'm sure many more companies will go public and set up a trend. But I think this will be evolution of a new business where we'll see a lot of companies getting started, become private for 10 to 15 years and then build another 25, 30 years in public. And that potentially creates a lot of iconic companies out of India, where we are not building companies to sell to others, but we are building companies who will buy other companies and become very large. If as a country, we want to build companies like Apple or Cisco's, we have to have Salesforce. We have to stop selling our companies. We have to start building companies which can set up an anchor and gather everything around themselves rather than just selling and moving on.
And also, I think it coincides with a lot of growth stage funding getting stopped from US.
Correct.
Right? If a US investor, a PE has to put 500 million, he wouldn't put 500 million now today in a private company in India valued at 5 billion. He would rather buy a public business in US.
But I think it's a matter of time. I think it's a 12-month slowdown. In my opinion, after 12 months in 24, you will still see those crazy rounds happening. So I think so far, as a founder, most founders in India have only seen this one and grow kind of playbook. Now people will see this another kind of playbook where companies can go public and eventually build it out over long term. I think it's another playbook. I think, and I'm hoping that over time, founders will have to make that choice. That do I raise money at the peak of cycle at the most premium valuation possible and then push my IPO for another 5 years, or do I sort of hunker down, go towards profitability and start building in as a profitable company in the future?
For founders, till now, unicorn was the highest level of aspiration.
Absolutely.
That they wanted to attain. I think that needs a little bit calibration.
Absolutely. I think it's just a different way of building. I think people will, as you see more examples, it will happen. If you look at it around us, among our shareholders, I think when we started thinking about it, we also realized that a lot of people around us are also thinking, and then we sort of inspired or learned from each other a lot. And over time, I think it is just people do what they see from others, what they see others doing. So I think it will emerge, in my opinion, as a big playbook. And then typically my sense is that investors will not sell at IPO. They will continue to hold till their end of fund life cycles and then sell accordingly. You are also seeing in US that Sequoia is now moving away from private only to also evergreen and sort of holding public equities. So I think that demarcation of only being private and public will sort of start to merge, and a lot of will do a lot more crossovers in future. So I think I see it as also a natural evolution of how these asset classes interact with each other globally, not just in India also.
Thank you so much, Abhishek and Neha. I think you guys have today spelled out the entire playbook of how to take a company public in India.
No, thanks a lot, Siddharth. It was awesome to speak. Glad to be here.
Thank you, Siddharth.